All the big voices for you here on ET Now. Let's also welcome in our next guest, Ayaz Motiwala, Senior Fund Manager at Nivalis Partners, joining us. Ayaz, good morning. Global markets going from strength to strength, new records back home here as well. We're hitting records and looking pretty good, particularly post-festive season. Earnings have been more or less intact. What are you making of the current momentum?
Yeah, I mean, yes, the markets have hit a new lifetime high, and generally there's buoyancy. There's been a very sharp sort of hope built up on recovery, as we sort of note recently, and like there is some sort of anecdotal evidence on the two-wheeler side. There's reduction in auto inventory, particularly two-wheelers and cars. There's some sort of confidence on buying in the Diwali sort of festive period. And of course, the more recent sort of tax reforms by the government. So those are kind of building up this confidence, if you will.
Okay. So some elements they're building up confidence. Are you also looking at this momentum playing out now in a sustainable manner? Ayaz, would you be looking at, perhaps, allocating further chunks when it comes to the Indian market, looking at expanding the basket? How are you strategizing at a time like this?
Yeah, so we, so ours is as an Asian mandate. So it's not a, country-specific fund. And thus we have obviously flexibility to increase our weightage to any country. We are sort of bottom-up quality investors, and are constantly on the lookout for high-quality businesses, which makes sense in terms of what is implied in the growth and what we are paying to purchase those cash flows. So if that if that mix is appropriate, then we would like to own more in that particular country as such. I've said this in the past that quality has obviously been an expensive purchase anywhere in Asia, and more particularly in India. So with that backdrop, it's obviously tougher to find easy sitting value. So in some cases, we are paying up pretty high valuations for proven quality companies. And on the other side, we're trying to buy some sort of, quality where there is a challenge on the growth front, or they've been hit on margins or raw materials, etc., have caused an impact on their profitability. So that's the kind of way we are trying to approach our quality investing.
Right. Ayaz, what has been your last acquisition? Last time when we spoke to you, you were buying into chemical companies, you were buying into NBFCs. We haven't spoken in a while. So I'm not fully updated on your, last, major investments. So why don't you walk us through last 3, 4, 5 months? What's been the update at your end in terms of what you bought and what you've sold?
Sure. So, so I was just listening into your colleague on the question earlier. And so let's put it this way, that at this juncture in the last 5-6 months, I think we are in the second round of quality at any price kind of situation right now, and that's being questioned, of course, by great sort of market participants and good investors all across the board. In our case, in specific, we've sort of added to a few of our auto part companies where we are hopeful of a recovery in autos, and basically added a couple of other consumer type names, or consumer specific consumer FMCG companies, and I'd love to illustrate one of that where. Which brings that whole point of, either a debt situation or governance or sustainability or growth, and why sort of promoters have come to a point where they have a choice to either sell down, or in some cases the company, is being taken over by lenders as such. So in this case, there was a large block of sell down by the promoter, and we participated in that company.
Right. Ayaz, you track the consumption space rather closely. You know, while they're all bracing, and purely FMCG, they're all bracing for a tepid second quarter, ITC managed to spring up a surprise because of that, tax adjustment. But net, what is your view on how consumption should be looked at from here?
Yeah, so again, sort of going back and looking at it from a like a 2-5 year perspective in the past, and then looking a little ahead. That gets the argument from our perspective appreciated by y'all. So I would say that over the long history of the Indian markets, consumer companies, which along with a few other type of businesses are commonly accepted as quality businesses, which make sustained high return on capital, don't need new injection of capital, have a high dividend payout and solid balance sheets and profitability. And they've always traded at a premium of over, let's call it the Sensex or the Nifty, of sort of between 50 and 150%. To put that in numbers, let's say if, at the very low point, if the Sensex traded at 12-13 times, these stocks were trading at 18-20 times multiples. And as we speak now, that multiple is probably towards a 2.5x of a Sensex Nifty multiple of 20 odd. And so that's why we're seeing these 40 to 60 times earnings. That sets the ground for the sort of relative valuation situation as such. The other point that I would like to bring about is that in the last 5 years of this government, the market participants did meander around on the hope of a growth recovery. And if you were to see the factual numbers, growth across the board is woefully missing. And, the Nifty earnings are probably in the ballpark of 3 to 4% or thereabouts. And there's obviously a lot of exclusions on oil and financials that one can make. But suffice to say, earnings growth has been limited and has been disappointing. So the element of growth is one that people have veered to. And then second, in the more recent couple of years, is the challenge on governance, which is the other sort of aspect which is affecting investor behavior, which anyway typically towards the end of a cycle goes towards a flight of quality. And this is further accentuated by the whole sort of ILFS episode, the debt issues with lots of promoters, and a host of smaller companies sort of turning out to be having very poor numbers or kind of going bankrupt in a very short period of time. So all of these factors put together, is pushing investors towards a particular corner where there is and they are paying up, either willy-nilly or in the hope that there is near-term sort of growth. So the forward argument now, very quickly, is that if the growth were to broad base, and we're seeing some signs of it as we talked about. I mean, there's an auto recovery and some auto part companies take off. There's a consumption recovery and other things happen. Then I guess the very narrow width of the market would broaden up, which is again a typical market cycle. And I think that's a good thing, for investment, market participants, that the investment rally is more broad based than too specific to 20-40 stocks.
Okay, Ayaz, appreciate your time.